radio for a really great future. We're talking real money.
I just realized that intro says radio, and this is a podcast. See, that was originally created when it was just a radio show. But now it's more of a podcast than a radio show. I mean, 5 days a week, we're a podcast. And 1 day a week, we're a really great question and answer podcast. That's today. It's the Friday Q&A podcast, my favoriteest day of the week. Hi, everybody. Don McDonald here on the Talking Real Money podcast. I should have my my disclaimer announcer at the end redo that. That disclaimer announcer is my daughter. She works cheap. She does. She works cheap. Welcome. Glad you're here. We actually have a pretty good supply of questions today. Enough came through really recently that I have 5 today, I believe. Yes, I have 5. So we've got some good stuff coming up. All of these questions came in through the TalkingRealMoney.com website. You go to TalkingRealMoney.com, you click the Contact Us button in the upper right, and then you speak your question into a microphone on your electronic device, whether that's a phone, a tablet, or a computer with a mic hooked up to it, like this. I mean, that's what this is. What am I talking into? A mic hooked up to a computer. All right, so it's a fancy mic through a fancy interface into a fancy computer, but it's a mic in a computer. So do that, and then I'll answer those questions on Fridays. Otherwise, you can type them, and then they get answered, I don't know, sometime. But that requires you listen to more shows. You know, if you only want to listen to Friday, then speak them. Let's go to the first question that came in from TalkingRealMoney.com. Here we go.
Hi, Don and Tom. My 33-year-old daughter has saved $330,000 in her 401k account. I believe she has done very well, but when she showed me the funds she is invested in, I thought she could do better in her choices. She is currently invested in an intermediate cycle fund. There are 4 other funds she can also choose from. They include the Wealth Preservation Strategy Growth Fund, the Wealth Preservation Strategy Conservative Fund, PIMCO All Asset Fund, and the BNY Mellon Global Fixed Income Fund. I told my daughter she may be better off with just the 3 Vanguard funds and the DFA Global Real Estate Fund at such a young age. My question is, what would be the best plan of action going forth for her since she has at least another 30 years or more of investing ahead of her before she retires? My daughter is interested in hearing your take. Thank you in advance.
Well, I edited the question because I didn't want you guys to have to listen to the laundry list. The number of funds in that intermediate cycle fund, isn't that a name? It was a huge list of funds from American Funds, Vanguard, DFA, Dodge & Cox, just all kinds of fund managers. And then the other ones, the Wealth Preservation Strategies funds, these sound a lot like choices that come from this new type of 401k management system that it's called a collective investment trust. It's run through a bank trust company. And this sounds a lot like one of those. Charles Schwab also has them. Fidelity has them. You know, State Street has them. They are a way around the traditional mutual funds. And they're private institutional investment pools that you can't really track effectively, and like these, get a little muddy in trying to determine what they're doing and how they're doing it. Now, you mentioned that she has Vanguard funds, but you didn't say what those funds were. If she has just plain old Vanguard funds, those might make more sense than getting into, for example, this intermediate, what was the name of it again? The Intermediate Cycle Fund. That's it. The Intermediate Cycle Funds. These things they're market timing funds in disguise. it's a great way of calling them market timing. What they're trying to do is predict economic cycles, business cycles, interest rate cycles, inflation cycles, stock market cycles. They're trying to predict the future, which is market timing, and then they reallocate based on what they think the future looks like. Well, you can tell what they think the future looks like is pretty much a little bit of everything. So, but we don't know what it costs, and that's the other problem with these CITs. They say they cost less, but good luck figuring out what everything costs. It's very, very difficult to do so because the disclosure requirements aren't as high. Right now, I'm not a big fan of CITs. She's got it. It's what she's lived with. She's put a lot of money in there. She may very well be in the best choice, given that those wealth protecting strategy funds are going to do some sort of hedging to try to keep from losing money in down markets. They're trying to create magic investments because those are very appealing to the participants. Oh, well, you're trying to put me in the right stuff at the right time. You're trying to protect me from market declines. If there are straight mutual fund or ETF choices, well, let me know, and we can look through those. But if there are straight equity mutual fund choices at her age with the amount of money she has, that may very well be a better option. But for right now, she may have the best. I don't know. It's opacity. I hate it. I love transparency, which is another reason why I'm not really a big fan of these CITs. At least you know which funds they're in. But that could change at any moment, the percentages of those funds, which funds they use. Thank you so much for the call and the question. I hope the answer helped. Now it's time for the next one.
Hello, Don. Don from Wisconsin here. I love your show and I miss very few podcasts and seldom find myself questioning your answers. However, I think your answer fell a bit short on the 1222 podcast. That was the fellow whose parents are in an investment club and they want to transfer securities rather than cash to their Schwab account. I've been in investment clubs that are affiliated with Better Investing, formerly known as the National Association of Investment Clubs, for almost 35 years, and it's been an encouraged practice for one who is doing a full, not a partial, but a full withdrawal, to consider transfer of certain club shares in an amount equal to their value rather than cash. The son was correct that if the club has to sell securities to effect his parents' withdrawal, all members will realize a proportional capital gain for the year on the sales. However, if the shares representing their value are transferred from the club to the account of the withdrawing member or members, the remaining club members would not realize a gain because of that withdrawal. This method has always existed for investment clubs, assuming the withdrawing member has or opens an individual account with the same brokerage. In regard to the issue of the Schwab representative telling them they can't transfer shares, there have been all sorts of problems and discrepancies with Schwab's practices with investment clubs since their takeover of TD Ameritrade. TD Ameritrade previously never had a problem with this method of transfer, and Fidelity, E-Trade, Siebert, and others continue to effect those transfers as they've always done. Around the country, some Schwab representatives are saying it can't be done. Others have worked with clubs to continue the practice. There's a lot of confusion. On the other hand, several clubs were told outright that Schwab simply is not interested in working with investment clubs. This has resulted in all sorts of confusion, and a significant number of clubs have decided to transfer their business and assets to Fidelity.
And then it died. The caller, for some reason, the recording died. But your point is taken. Yes, it depends on how the investment clubs incorporating documents are written up. They have to create some sort of a corporate partnership structure. Generally, it's a partnership structure. And they can require that they do it in kind, but you have to have, as you said, you have to have a custodian who will allow that too. So there's not one answer. Some clubs allow it in kind. Other clubs, in fact, do not, and they require that anytime they sell, they cash out and or have to sell to buy somebody out, and everyone incurs a capital gain or capital loss depending on the position. So thank you so much for the correction. And now the next question.
Hi, Tom and Don. I really appreciate your show. I found you through Clark Howard about 1.5 years ago. You're informative and really funny. Thanks for all the work you do for us week in and week out. I've got a question about Roth conversion. I'm 61, going to semi-retire to about 50% work in a couple of months. Our income at that time will be about $150K between my work and our pensions. My wife, 67, is retired. Our combined pension is $86,000. Our prospective combined Social Security is $64K at age 70. This value that I'm giving you is only 75% of the value Social Security reports to us. Hopefully, we'll get closer to its currently reported value of $85K, but not too hopeful. Neither of us plans to take it until age 70. We have about $263,000 in a taxable account invested aggressively for long-term care. It's not mixed with the rest of our portfolio. Another $1.4 million is divided between a small beneficiary IRA, 2 IRAs, 2 Roths. 29.5% of it is Roth. That portfolio is mostly in dimensional funds, 27% international, 42% domestic, and 31% fixed income. When we're completely retired, using a flexible 5% of our portfolio plus Social Security and pensions, our income would be about $219,000. At the risk of sounding political, taxes in our current income level are as low as they've been in 100 years. And we are in such debt as a country that I can't see how they won't go up. Also, warning, politically charged, but meant to be descriptive. The party in power is motivated to keep taxes artificially low comparative to spending, but will not always wield power in both houses and the executive. I also worry what will happen at this income level once either of us passes and has to use the single rate rather than married filing jointly. We floated the idea to our advisors of converting the top to the top of the second IRMAA tier for the next 3 years. This would be well into the 24% bracket, which would allow us to convert about $450,000 and flip our portfolio to 70-30 Roth to IRA. We would then use our IRA for income to whittle it down eventually to leave enough money there to use it exclusively for charitable giving. We're tithers. Especially when my wife reaches the age when doing so would count as a QCD. I calculate with 3 years of IRMAA penalties and converting into 24% bracket, the premium on that $450,000 conversion in the 24% bracket would be about 3.7%. Given that it will likely grow to much more than that, I estimate that $450,000 would grow to about $1,350, growing at 6% over 20 years. I reasoned that the premium on that $450,000 would be a bargain compared to paying a higher rate on 3 times the original. I'll have to use a significant portion of the long-term care account to pay for the extra taxes incurred for the conversion. I plan to repay that over time, keeping track of the lost opportunity cost and repaying that too. Think I'll be able to finish that when I reach age 70 to 72. My advisors seem to think that it's not a great idea, though they haven't come right out and said it. I'm trying to understand why, other than that it means that I'm trying to predict the future regarding taxes when my taxes are currently and might possibly remain lower. I reason that if I wait and taxes do go up, the chance is lost though, and probably for the rest of our lives. Can you please comment and advise, if you dare, on my idea and my reasoning and the advisability of this of executing this plan? If you think it's inadvisable, can you please tell me why? Thanks so much for any light you can shed on this for me, and Happy New Year.
And Happy New Year to you. Thanks for listening, and thanks for thinking we're funny. First, are you an engineer or an accountant? You're something very analytical because you really put a lot of thought into this. And you really made some great arguments, but you made my brain hurt. I have to say that. And I apologize to all of you whose brains might be hurting because there's a lot of information there. A lot of great arguments, but here's the problem, okay? It works if your prediction, which you kind of couch as an assumption about future tax rates, is right. I've been around for a while. Tax rates have been supposedly going up for 40 years or so, roughly. And nobody knows. Congress doesn't know. not even Tom. Nobody knows what that future tax situation is going to look like. So what you're proposing, just for everybody's clarification, is a guaranteed 24% cost now, plus the IRMAA penalties, taking money out of your long-term care fund, which kind of messes with your flexibility to protect yourself from a tax increase that you do not know is going to happen. I think that's where your advisor's hesitancy is coming from. You've got to, what you're doing is you're turning hypothetical into actual. And you're also, I think, assuming that someday you're going to be forced to take everything out at that high tax rate. And by the way, where did you get the 75% of your Social Security? If you mean taxes, okay. If you think the government's going to reduce it, again, you're playing guessing games. I would not imagine the government is going to reduce your age 70 payout. I really wouldn't. You're too close to getting it. Anyway, just bottom line is with your pensions, the Social Security, which you get that's huge, your Roths, your IRAs, and, later it sounds like you're going to take given the fact that your financial situation is so good, a ton of that IRA money, and it could be most of the taxable IRA money, could be spent in, as you said, you tithe in QCDs. So you have power to control your income. There's no hurry. You do not have to do this right now. You could do small conversions, the kind of conversions that you can afford from cash flow year by year. And if you're wrong, well, we're always a little wrong about the future. You just have flexibility. You just slow down. I really think you need to slow down. Just keep your options open. You shouldn't make big moves based on your feelings. And that really is what this boils down to. You got a lot of analysis in there, but the bottom line, it's how you feel that is pushing you toward this decision. And I would advise, like your advisor is doing, against rushing. Do it slower. Thank you so much. Let's grab our next question, shall we?
Hi, Tom and Don. I'm concerned about the growing national debt, the government's apparent unwillingness to balance the budget, and how these factors could impact the bond portion of my portfolio in the years ahead. If major foreign buyers of treasuries, such as China and the UK, were to reduce their purchases, pushing interest rates sharply higher and prompting the Fed to use additional quantitative easing, I worry that dollar debasement and higher CPI inflation could significantly hurt my nominal bond holdings. Given that, what are your thoughts on replacing BND with VTIP, as my core bond position? Could you walk me through how TIPs work, the role they can play in a portfolio, and the main reasons they should or should not be a meaningful allocation for me? Also, can you explain the key differences between short-term TIPs and longer-term TIPs, and how to think about which might be more appropriate in my situation? Thanks, Jim from Austin.
Well, Jim, there's a theme, and I understand the theme. We're in a political situation right now where it feels uncomfortable. The dollar's value has been recently plunging. And some like that because it makes U.S. products cheaper, but it also makes imports more expensive, which, I bought some things that were imported, and I swear to you, I'm paying the extra money in the dollar loss and in tariffs. I don't think the German companies from which I bought things paid them. I think I did. I'm pretty sure. I know I don't want to sound political, but it's math. Again, don't panic. We had a very similar situation happen just a couple of years ago when we were worried about the devaluing of the dollar and inflation and all those things. And BND went down. It lost about 13%. It was the worst year it ever had. It was the worst year the bond market had in, I think, pretty much forever. Here's the deal. I get your worry. I worry about it too, but I don't make wholesale changes in portfolios based on worry. I don't. I can't. You shouldn't. No one should. Stop overthinking. All of this that you know is already priced into the market, okay? The market only reacts to surprises. And these are, when you're talking about it and every other caller, there's no surprise. Everybody knows that it's built into the current pricing. And by the way, the only time tips work reasonably well is when we get surprising inflation, like, oops, I didn't expect that. Tips are just Treasury securities that adjust pretty much just the rate of, they give you the rate of inflation. There's short-term tips. VTIP is a short-term tips fund. They're real stable. They react pretty quickly to surprise inflation. Okay? Yes, there's nothing wrong with having a small portion of your portfolio in a tips fund like VTIPs. VTIPs is very conservative. Expect to make basically nothing in periods of low expected inflation. It's a hedge in case there is inflation when BND would go down some. So, yeah, you could have some, but do not sell a massively diversified bond fund like the Vanguard Total Bond Index over these concerns, which, by the way, about 30% or less of all of the U.S. government debt is owned by foreign investors. Who owns 70+% of it? We do. You do in BND. I do in BND. Got to control the emotions. Most important thing any investor can do. We worry. We think we have these massively big brains. They think all the time. Tell it to stop thinking about the portfolio. You built the right portfolio for you, right? If you have, it should work good times and bad. Yes, sometimes you'll lose money. You cannot avoid that. You can't time your way out of that. And let's see. Time. Do we have time for another question? I think we do. Let's grab it right now.
Hi, Tom and Don. My name's Jason. I'm 54 years old. I would like to retire at 59 and a half. My question involves myself inheriting approximately $80,000 from my uncle 2 years ago, which I was able to roll over from his IRA to a retirement IRA in Vanguard. My plan was to let the money grow till I hit 59 and a half and then remove the money, pay the taxes, and use it in retirement. But now I'm thinking a better option is to withdraw approximately $8,000 a year to fully fund my Roth IRA so I can use those funds that have been going in there to max out my 401k with my employer, because currently I cannot max out my Roth IRA and also the 401k combined. So should I let the money roll in the inherited IRA, or should I slowly cash money out to fully fund my Roth IRA? Thank you. Have a good day.
Your plan is a pretty darn good one. Just make sure that you schedule it in such a way that you get it out. Well, you said it was a couple of years ago, so you got to have it out within 10 years of when you inherited it. You have to take it out and pay taxes. The way you're thinking about doing it is so wise because you're not as likely to kick into a higher tax bracket if you're taking $8,000 or so a year. You get it in a Roth, which now grows tax-free for life. You take care of that 10-year rule that you get it out before the IRS is going to penalize you. You check all the boxes. So your plan, it's simple, it's sane, it's disciplined, it's good. I like it. Go get it. Thanks for the call. Thanks for the questions from everyone. I thought today's questions were really good ones. I mean, a little long, but that's okay. A couple of more, some were really short. I just took out the mutual funds. I can do that kind of stuff. I have the power. So yeah, leave longer questions with lots of detail and leave it up to me to take the stuff out if I need to. thanks so much for being there. Thanks for calling in your questions, speaking them at talkingrealmoney.com in the contact form. Please tell a friend or 10 about this show. We're consistently getting great listenership on all the big podcast services, but stacking Benjamins is still ahead of us, so we need your help. We're an older crowd, but we're important. So be a part of the Talking Real Money listeners on your favorite podcast service. And again, send in your questions, call in your questions, whatever it is you do with your questions at talkingrealmoney.com on the contact form. Thanks so much for hanging out with me as we are talking real money.